My first one would be like a general one, because clearly cutting rates at the same time with hiking in the inflation forecast needs perhaps a little bit more explanation. And also the question whether you perhaps pre-committed yourself too early to that cut. The second one is the market currently is expecting some 65 basis points in cut during the course of this year. Is the market right or about right? Thank you.
Well, thank you so much for your opening question. And let me take this opportunity to give you a bit of an opening answer and tell you what we did this morning and what happened as a preamble to this morning's decision. But let me first tell you that we started our meeting this morning by paying tribute to the many men and women who sacrificed their lives on the beach of Normandy today, which is the 80th anniversary of D-Day. And we paid tribute to those sacrifices and those of many others because it enabled us to build what we have built, to disagree in a very civilized way, to have very harmonious and congenial decisions amongst 20 different nationals representing their respective national central banks amongst our governing council. And it was perfectly appropriate and fitting to do so. Then we decided to cut. And we did so because overall, our confidence in the path ahead, because we have to be forward-looking, has been increasing over the last months. So let me explain to you why our confidence has increased in the path ahead. And I will take you back a little bit, because this is, after all, the first time in many years that we make that kind of decision. And these things do not happen in a vacuum. So I'll take you back a little bit to our monetary policy cycle to remind you that we have had two successive phases, and we have made that decision. So the first phase, as you will remember, was a phase of very robust and rapid tightening. We tightened by 450 basis points between July 22 and September 23. Then we moved into a phase of holding from September 23 up until today. And if I look back, and we look back at those phases, during each of those phases, we divided inflation by half. So if you look at the peak of inflation, October 22, we were at 10.6, double-digit inflation on average. Now fast forward, September 23, we are at 5.2. Fast forward to today, we are at 2.6. So at each and every step of the way, when we reassess and decided to move in a different direction, we had halved inflation. I think the second element that we took very much into account was the reliability and the strength of our projections. And there is one particular line of projections which, to many of us, was relevant. If you look at Q4 25 projections, you look at September, you look at December, you look at March, you look at June, there's a variation between those projections of 0.1. So it's either 2 or 1.9 or 2 or 1.9 or 2. And it's on the basis of this reliability and solidity and robustness of those projections that we have made that decision to actually cut. But we have done that, and I'm sure that you will be asking, what about next time? Yeah. And I will invariably tell you the same thing, which is what is included in the monetary policy statement. We shall be data dependent, and we shall decide meeting by meeting. But to say that is probably not enough. And how we collect data matters, but what is also more important is how do we analyze the data? And I'm not only specifically pointing at one set of data, all the data that we get. We're looking at it under the prism of our 3 criteria. And you will have noticed that I have repeated 3 times, I think, in this monetary policy statement, the 3 criteria, which are the inflation outlook on the basis of the financial and economic data that we collect. It's the underlying inflation, and it's the transmission of monetary policy. So it's under the prism of these 3 criteria that we analyze all the data that we have available. And we need to have those data. We need to have enough of those data to make a relevant and appropriate analysis that took us this time around to this decision.